So let's continue on here in chapter 6, and this is the big discussion on depreciation. So as I had mentioned earlier, depreciation for tax purposes is different from depreciation for financial accounting purposes. Financial accounting, if you recall, I mean, you've got some main methods of depreciating assets, but you've got a choice, right? You could go with straight line, you could do some double declining balance or triple declining balance, or some of the some of the years, you'll learn that in intermediate. Some of the years, I don't know, something like that. I can't remember. It's been a long time since I've taught that. But all these different choices. You also have this concept of salvage value with depreciation, meaning you think that this asset that you purchase is going to be worth something at the end, and so you have to factor that into your depreciation calculation. In tax depreciation, you do not have a choice of method. Well, you do. You get a couple of choices, but your choices are extremely limited, and certain assets you do not have a choice in how you're going to depreciate. There's also no concept of salvage value. So what you depreciate, you're going to depreciate the whole value of whatever that asset is. Now, there are some things that are the same as well. So remember, in financial accounting, when we depreciated an asset and we got our cost and our book value of the asset, we added certain items to it. Like if we paid for shipping, any taxes that we paid for the purchase of the asset would be included in that asset price. Any installation charges, any testing, anything like that gets all wrapped up together in the book value of that asset and wrapped up in how much we're going to use to calculate depreciation. Same thing for tax. So we would still include all of those different costs of acquiring the asset along with the actual asset when we're determining what our depreciable basis is. Okay. Now, we use the term kind of depreciable base in financial accounting. In tax, we use the term basis. So basis is, and our cost basis is essentially the what we spent in order to attain that item and get it ready for sale. And you're gonna hear me use that term basis a lot in this chapter and in following chapters. And maybe you've heard me say it a couple of times already and weren't quite sure what I was talking about. Well, you're gonna learn what it means in this chapter. So we all know what depreciation is, right? It's in tax, they call it cost recovery. So you purchase an asset, and the whole concept of matching our expenses with our income in financial accounting is that results in spreading out the cost of this asset while it is generating income for us, right? While it is useful to us in that generation of income. So same concept here. So it's kind of funny because it is sort of, we've talked about how this is tax for the most part, at least for individuals, is cash basis. Well, depreciation isn't cash basis. This is accrual basis, right? If it was cash basis, we just write it all off when we purchase it, but we don't. We expense that out over time. And they refer to that as cost recovery in tax accounting. So for tax, we have these 4 components, 4 pieces of information that we have to go through to determine how we depreciate an asset. Some of these will sound familiar and are pretty easy to relate to. Actually, most of them are pretty easy to relate to. This third one, depreciation convention, is a completely different concept for you. Okay, so we're going to go through these one by one in establishing how to depreciate our assets. So first thing we need to know is what is the basis. Again, That is the cost of the asset plus the cost of acquiring the asset and getting it ready to use. Depreciation periods. They refer to those as asset class lives. So the type of asset determines how long you depreciate that asset for. You don't get to choose. Like if you, this table here, we figure it's gonna last us, 15 years or so. For financial accounting purposes, we can depreciate that over 15 years. For tax purposes, we can't. They tell us how long, because of the type of asset it is, how long it has to be depreciated over, okay? And those are our asset class lives. So there's just like a whole list of different types of assets, and then they tell you. So that's actually kind of nice, isn't it? You don't have to make any decision there. That information is given to you, told to you. Then we got this concept of convention, depreciation convention. I'm not talking about going to a convention and a depreciation convention. Doesn't that sound exciting? Let's all go to a depreciation convention in Las Vegas. No, depreciation convention, there are 3 different times during the year. Well, no, I shouldn't say that. Let me back up a second. So in financial accounting, we start depreciating an asset when we put it to use, right? So if we bought that table and we started using it October 1st, we would start the depreciation on it October 1st. If we started it October 15th, we might start depreciating it October 15th. I mean, we could do that. That's not the case in tax accounting. In addition to being told how long you have to depreciate an asset over, you also are told when you can start and stop depreciating an asset. And it is almost never on the actual date that you start, that you put it into service. So this whole concept of depreciation convention is dependent upon the type of asset, the value of all assets that you put into service during that year, and when you purchased it. In general, when you purchased all of those assets during the year. Like I said, this is a completely foreign concept, so we'll spend more time going through what all of that means. There are 3 different depreciation conventions: half year, mid-quarter, and mid-month conventions. So we'll go through what those are and how we determine which one we use, and then once we know which one we use, how the heck do we use it? And then our last one is depreciation method. So in tax depreciation, there are essentially 3 different methods for depreciation. We don't have a whole lot of, we have some choice in which one we're going to use in some instances, but for the most part, we are told which one we're going to use. So those 3, we've got 2 declining balance methods, 200% and 150%. 200% is used, the least used method. And then we do also have straight line method. And we also have times when we have to switch methods while we still have the asset. You let Hi. No, that's okay. Come on in. I'm glad you're here. So these are the 3 methods, and like I said, there are times when we are actually required to switch methods in the middle of owning this asset and still using this asset. All right, so let's talk about depreciable basis. So we've got a 4, I'm just gonna write this down. 4, I'm gonna write down the black marker, which is back here. Or not. So these are our components. Oh, that's a bad one. So first one, basis. But the other thing is our basis gets adjusted over time. We'll talk about that. So it gets adjusted up and down over time. Second, third, slides, otherwise known as class lives, conventions, and our method. So those are the 4 things that we've got to go through. So let's start with basis. As I mentioned here, it's similar to book value. So again, it's going to be the cost, what you paid for the asset. Even if you borrowed to purchase the asset, we're talking about the purchase price, not necessarily the cash that you outlaid in order to gain it, because maybe you borrowed, $10,000 and only put $2,000 down on an asset. You still get to depreciate the full $12,000 of that asset. So, and this is one of the brilliant things about tax depreciation, is that you actually get to take deductions for items you haven't paid for yet if you borrow in order to obtain those items. So it is usually our initial cost plus any of the costs associated with the purchase. The depreciable basis, though, can differ depending how it was acquired. So if a property is inherited, and this happens, you inherit a piece of personal property and then convert it to business use. And by the way, we only depreciate business property. We don't depreciate any personal property. We don't depreciate any investment property. Okay, this is only business property that we are actually going to depreciate. Because again, depreciation is an expense, and if there's a business, then there's income attached to that. So you got both sides. So if the property is inherited, generally speaking, the basis is the fair market value of the item at the date of death of the person that died. So grandma bought a house back in 1974 and it cost $7,000, and now it's worth $500,000. She gives it to you. It's, on a rural piece of land, and you're going to start a landscaping business, and you're going to put all of your equipment and everything out there, and that's going to be where you locate everything, and it's going to be your business property. Well, instead of depreciating $7,000, you get to depreciate $500,000. So you can imagine that that's a lot more expense that you are going to get to offset your taxable income. Generally speaking, it's the fair market value at the date of death. Sometimes we convert personal use property to business property. So my landscape business, maybe I had a truck beforehand, and it was just my personal truck. I'm going to now use that 100% in my landscaping business as well. I'm converting it into business property. The depreciable cost is the lower of either the fair market value or the cost at the date of the conversion. So whichever one is lower of those two. They talk about these non-taxable exchanges, so like trade-ins and stuff. They're called 1031 exchanges. They're not as popular, not as common as they used to be. You used to be able to defer any gain on the trade-in. Like if you traded something in and what do I want to say? So let's just say you traded in a truck and you had depreciated the truck, and you were down to zero cost basis on the truck because you depreciated it fully. But you trade it in and you get $10,000 value toward the trade-in. So you're getting $10,000. You used to be able to defer that $10,000 gain, but you can't really do that anymore. You can only do it with land, okay? That's not something you necessarily need to write down. I'm just kind of telling you as an aside. So when they're talking about the trade-ins, it doesn't really happen all that often, but when it does, so the depreciable basis received after a trade-in is the cost of the new asset minus any deferred gain on the old asset. So what you would do is that $10,000 gain would then attach to the new asset in the form of a reduced basis. So I know that's kind of confusing to think through. So you've got a, so again, so let's say we've got a truck and it had a zero basis and you traded it in and you got $10,000 trade-in value. And you bought a new truck. This is old. New truck for $50,000. What happens, instead of paying the gain on that, because you're getting $10,000, it's like you got $10,000 cash, right? Because you're getting it now this is $40,000 to you. What happens is that $10,000 attaches to this new truck, and your basis is now $40,000. So when you sell that truck, you're going to experience that $10,000 gain at that point, right? Because if you, let's say, I mean, trucks don't appreciate in value, but let's just say you sell this truck for $50,000, or let's say $60,000, and we won't even talk about depreciation at this point. You sell that for $60,000. If you got a $40,000 basis, your gain is now $20,000 that you have to pay tax on. Before, if you didn't do this transaction, it would be a $50,000 basis and your gain would be $10,000. So it increases your gain on a subsequent transaction by that $10,000. So you're just postponing it. Let's see. Where did I stop? Oh, they've got a table in here. I can show it to you. So this kind of tells you how to determine the basis. So if you purchase it, that's easy. It's whatever you paid for it. If it was converted from personal to business use, you got to compare the cost, what you paid for it, or the fair market value at the conversion date. I think they said that backwards.
I know, I was so confused.
Yeah. Lower the fair market value or the cost. This should be reversed. The cost or the fair market value. I read that like, doesn't.
And I was like, how do you get cost at time of converted? Wouldn't that be fair market value?
I know, exactly. So the cost, so what you paid for it, or the fair market value at the date of conversion. So that truck that I'm now using in my business, I paid $50,000 for it. It's now worth $8,000. Well, it's the $8,000 that I'm going to use because that's the fair market value and it's lower of those two. So now I'm going to depreciate it based on the $8,000, not the original $50,000 that I paid for. Non-taxable exchange, assets cost less the deferred gain on the old asset. So I gave you that example over here. And then inherited, the fair market value at the date of the person's death. So those are, because these are, you don't just purchase items. There are different ways that you can acquire assets. So here's an example. We got Ashley. Ashley purchased a computer for $2,500 to use it in her sole proprietorship business. She also inherited land and a building from her father. Land had a basis of $10,000 and a fair market value of $18,000 at the date of death of her father. The building had a $150,000 adjusted basis and a $300,000 fair market value at his death. Ashley now uses both the land building for her office. The computer, that's easy. She paid $2,500 for it. Depreciable basis is $2,500. The building's depreciable basis is $300,000. That was the fair market value at the date of his death. Land also would be fair market value at the date of his death of $18,000. Land, however, we don't depreciate. Land doesn't depreciate. So whenever we're talking about a building that has land attached to it, you have to separate out the value of the land from the value of the building. Okay? so that you don't depreciate that land. Now, she also converted to business use an old van. Her basis was $13,000, but fair market value was $6,000 on the date of the conversion. She had held it for personal use. Lower of cost or fair market value is the fair market value, so now her basis is going to be the $6,000. Okay? All right. It doesn't matter if it's used, by the way. You still can depreciate it, whatever you purchased it for. Those rules still apply. It doesn't have to be a piece of new equipment or a new asset. Okay? Let's see. Questions about basis. So in that section, probably the most complex part is, and they screwed up the wording in there, is that, where is it? Cost or fair market value. So look at the chart, don't look at the words, don't look at the paragraph. All right. Let's move on. Talk about depreciation periods, class lives. They call them class lives. So, again, you don't get to choose how long you're going to depreciate an asset over. The IRS determines based on the type of asset. There are several different class lives. They go from 3 years up to 39 years. So there is an important distinction here with our class lives. We have to distinguish between personal property and real property and define what those are. Real property is real estate. Okay, so anything that has, so land, buildings, all that kind of thing. That is real estate. Everything else is personal property, as opposed to personal use property. It's kind of hard to, that word use in there is important, because personal use property means it's not business property. Whatever it is, it's not being used in a business. It's being used personally. So we're not going to depreciate it at all. Okay? But there's a distinction between personal property and real property. And one of those distinctions we see in the depreciation periods, real property is going to be depreciated over a longer period of time. So it's more on the higher end, 27.5 years or 39 years. There are two depreciation periods for real property. Those are the only two, 27.5 years, 39 years. So, different types of property. So, real property, 27.5 and 39. 27.5 year property is residential property. Apartments, rental houses, anything where somebody lives in. 27.5 years. 39 years is commercial. Commercial property. This building, commercial property. The gas station down the street, the building, commercial property. Office buildings, commercial property. People don't live in it. So the distinction is, if somebody sleeps there regularly, and that's their home, because I suppose you could sleep in your office regularly, and that's their home, then it's residential. If it's not intended to be lived in, then it is commercial. And the class life is going to be different. Now, for personal property, we generally have 3-year, 5-year, and 7-year. We don't really have this distinction so much with these. You just kind of have to look up to determine what that length is going to be. Now, the 3-year, specialized industry tools are probably more common, but racehorses, they actually do, you depreciate racehorses. You also depreciate livestock that's used for procuring more livestock. So for long term, if they're around for, so that bull, you know, they're also depreciable. 5 year, these are the ones that we're mainly going to be looking at. 5 year, automobiles, light trucks, computers, and peripheral equipment. These computers and vehicles. 5 year property. 7 year property, furniture, fixtures, and equipment. So, these tables, chairs, you know, all that kind of stuff. 7 year property. So these are the main, like I said, these are the main ones that we're going to work with. This one as well, and this one. This is mostly cars and computers, and this is mostly furniture and equipment. Oops. Right. Now you'll see that there are other class lives between those two. These two could be personal or they could be real. The other class lives. And they're mainly the 10 year, 15 year, and 20 year. Now, 20 year is for farm buildings. That makes sense. You've seen farm buildings, they take a lot of abuse. So they're not going to last long, they're not going to last as long. They're not going to be 39 year property, right? So they've got their own class life, their farm buildings. And then 10 year and 15 years, so you can see like vessels, barges, tugs, and fruit or nut bearing plants, which are not, those things are not real property, right? They're more personal property. But then we've got wastewater treatment plants and telephone distribution plants, which is kind of funny because most times those are like municipal type of plants, and they're not. I mean, when they're governmental, they've got whole different requirements. Now you'll see there also is this 31 and a half year. You can kind of ignore that. That is an old asset class life that goes way back to Ronald Reagan. It was eliminated back when Reagan was president, 1987. If it was acquired between January 1st, 1987, May 13th, 1993, actually, yeah, I think it was partially, when was it? Oh, probably because, okay, I'm talking to myself now. So this was an old non-residential, so the 39-year property used to be 31 and a half year property, but you have to have purchased it before May 13th, 1993. How many years ago was that? 1993. Oh, it's getting to be about 31 and a half years. I have a daughter who was born in 1995, and she's 29. So we're getting to be there. Pretty soon, in a year or two, we can take this off completely. There probably is some property out there that's still using that depreciation method, but the chances that the same owner still, you know, that originally purchased it during that time period still has it are pretty slim, but there would be a few. So we don't have to do anything with that, okay? That's it. Those are our asset class lives. Those are the time periods under which we're going to be working. Questions about the asset class lives? Okay. Okay, let's get to the fun stuff here. Conventions. We have 3 conventions. And it matters whether or not the property is personal property or real property, which convention we use. And I'm going to start with the easy one, which is the mid-month convention, because it's only real property where we use the mid-month convention. But every asset that we purchase is going to have a convention attached to it, okay? Real property, so that property which would have a 27.5-year life or a 39-year life, we will always use the mid-month convention. Okay, so real property, which again is 27.5 or 39 years, we're always going to use the mid-month convention. That means, regardless of when we purchased the property, placed it into service, we are going to start depreciating it in the middle of the month in which we purchased it. So, if we purchase something January 1st, we're going to start depreciating it January 15th. If we purchase something February 28th, we're going to start depreciating it February 15th. And so on and so forth. So whatever that month is, it's going to be, we're going to start depreciating it on the 15th of the month, mid-month. Kind of weird, right? That we don't actually start depreciating it on the date that we placed it into service. But that's just the way it is. So if I buy an apartment complex on March 23rd, I'm going to start depreciating it for tax purposes on March 15th. Because it's real property, it's an apartment complex, it's residential, so I'm going to depreciate it over 27.5 years, but I'm going to start depreciating it March 15th. The year that we purchase it, that's when we start depreciating it. The year that we sell it or get rid of it, we stop depreciating it in the middle of the month that we dispose of it. So if I sell it August 4th, I'm going to stop depreciating it on August 15th. So you're always going to use the same convention in the year that you purchase it and the year that you sell it. It doesn't really matter those subsequent years because you're depreciating it for, or those intervening years, because you're depreciating it all 12 months, right? During those years. So it's always going to be the same. Does that make sense? Okay, that's the easy one. That's for real property. Real property only uses the mid-month convention. So if it's not real if it's real property, you don't even have to look at those other conventions. Okay? So that'd be the first question you can ask. You know, you have an asset, is it real property? Yes. Okay, I'm going to use the mid-month convention. If the answer is no, then we move on. So for all other property, personal property, and that would be the the ones that we're using, 3, 5, 7, actually it's up to, I think it's up to the 20. I'm pretty sure. So 7, 10, 15, 20. We're going to use either the half-year convention or the mid-quarter convention. So, what is the difference between these two? You can probably guess by the name when you're going to start depreciating and when you're going to stop depreciating. With the half-year convention, you're going to start depreciating July 1st. You bought it January 1st, doesn't matter, July 1st, if you have to use the half-year convention. You bought it December 31st, doesn't matter, you have to use the half-year convention. You start depreciating it July 1st, sorry. If you have to use the half-year convention, you start depreciating it July 1st. If you have to use the mid-quarter convention, and we'll talk about when we use each of these conventions, how do we determine which one we're supposed to use? But if you have to use the mid-quarter convention, you are going to start depreciating it in the middle of the quarter in which it was purchased. So if you purchased it, so this one, half year, is always going to be July 1st. No exception, because that's the middle of the year. mid-quarter is gonna either be February 15th, May, is it May 15th? Middle of the quarter? Middle of the third quarter, August 15th? Or the fourth quarter would be November 15th. Did I get that right? Those are our four choices. If I have to use the mid-quarter convention, and I purchased my asset January through March. March 31st, I start depreciating it February 15th. If I purchased it, let's say April 27th through, I'm gonna start depreciating it May 15th. If I purchased it September 30th, I'm gonna start depreciating it August 15th. If I purchased it October 1st, well, let's say October 3rd. It's October 3rd. So if we buy something today, we're gonna start depreciating it, and we have to use a mid-quarter convention, we're gonna start depreciating it November 15th. All right. So again, this only applies to personal property. So your first question is it personal property or is it real property? If it's real property, I'm gonna use this mid-month convention. I don't even have to think about this stuff. If it's personal property, meaning anything other than real estate, and land doesn't count, like I said, because we don't depreciate it, then we've got to determine whether we can use the half-year convention or the mid-quarter convention. So let's talk about the difference between those two, and well, not the difference, but when we use each of them. So the half-year convention, actually we're gonna start with the more difficult one, the mid-quarter convention. If you have your first test, so your first test is personal property, real property. If it's personal property, which one do I use? First test you're gonna do is to see if you have to use the mid-quarter convention. If you don't, then you use the half-year convention, okay? So, first up, mid-quarter convention. If you place more than 40% of your personal property, again, we're only talking about personal property, in service during the last quarter of the year, and we're talking about the value of it, not like the number of items, but the value of your personal property. You place more than 40% of your personal property in service during the last 3 months of the year, then you have to use the mid-quarter convention. How do we figure that out? All right. So let's say we got 4 assets that we purchased, okay? Purchase price, and this is personal property, okay? 4 personal property assets. So first one was $10,000. Second one was $20,000. 15 and 15. All right. So the first thing we're going to do is determine, did we place more than 40% of our total assets, personal property assets that we acquired this year? We're only looking at this year. Did we place them in more than 40% of the value of them in service during the last quarter? So let's total it up first, and we'll figure out what 40% is. So 30 plus 30, so 60,000. These are our total assets. So we have to look at when we place them in service, right? So let's say this was January 17th. This was June 12th. This was October 3rd and December 17th. All right, So which assets did we place in service during the last quarter, or the quarter of the year? These two, right? How much was it? It was $30,000. Am I gonna do it this way? No, I gotta go the other way. 30,000 divided by 60,000 is 50%. I placed more than 50% of my personal property assets into service during the last quarter of the year. I have to use the mid-quarter convention on all of my assets, all of my personal property assets that I placed in service this year. In this case, I'm going to use the mid-quarter, which means, all right, so this one I'm going to start, when would I start depreciating this? It was placed in service January 17th, and I'm using the mid-quarter convention. February 15th. What about this one? May 15th. What about this one? And this one? Also 11/15. Okay, so again, first step, is it real property or personal property? If it's personal property, do I have to use the mid-quarter convention? Total up all of your assets that you purchased during the year. Total up the assets that you purchased the last quarter of the year. If those assets are more than 40% of your total assets, then yes, you have to use the mid-quarter convention. If it's not, then you can use the half-year convention. Then all of your personal property assets that you purchased during the year, you are going to start depreciating on July 1st. All of them. Why would they do that? Just to give us a headache? No. There is a reason behind it. It is to minimize the effect of people purchasing a bunch of equipment during the last quarter of the year and getting a full half year of depreciation. If you purchased everything, let's say we purchased all this 60,000 on December 31st, and we got the half year convention, we'd get 6 months of depreciation this year on all of that, because it would start July 1st, even though we purchased it December 31st. Does that make sense? So we're gonna get a huge depreciation deduction this year simply by waiting until the last minute to purchase all that equipment. So it kind of eliminates some of that tax planning that you can do. You still get benefits if you can still depreciate equipment for a year, a month and a half anyway, right? When you didn't have it, but you don't get 6 months worth of depreciation for that first year. So if that's the case, then we're gonna use the mid-quarter convention, and the date that we purchased it is gonna determine then when we start depreciating it. If we don't exceed 40% of purchases, personal property purchases in the last quarter, then we just use the half-year convention for all of our personal property. Again, real property, we're just gonna use that mid-month convention. Personal property though, it's gonna be one of these two. Questions? Completely different, isn't it? I just blew your mind. You had no idea this existed. All right. No questions? I don't know if there's an example here. Yeah, I think there is an example here. Oh, we started up here. Cal purchased the following assets during the tax year so you have to do this every year for the assets that you purchased that year, right? Next year, like I said, if you own the asset for the entire year, the next year it doesn't matter. You're gonna get 12 months of depreciation. If you don't, you've gotta use the same method that you used in the first year. So if it's a mid-quarter asset, in the year that you dispose of it, you're gonna use the mid-quarter again. So whenever you dispose of it, it's disposed of in the middle of that quarter, just like with that mid-month. And the same thing with the half year. Okay, so, and obviously, so this means you have to keep track of what method you used in that first year. Software does that. Software will do it, and it will automatically do this for you, do these calculations, but of course, your homework will not automatically do it, so you guys have to figure it out so that you understand the concepts. But I lost my train of thought. Anyway, let's go through this. All right, so purchase these assets during for his sole proprietorship. January 6th, equipment. May 4th, truck. December 1st, equipment. We can tell right off the bat, we don't even have to do the math on this, that he's gonna get to use which convention? What's that?
Mid-year or half year?
Half year. Yep, yep. Yeah, mid-year, half year.
Mid-quarter.
They call it half year. It's gonna get to use a half year convention on all of this equipment, because more than 40% of his equipment was not, or his personal property was not placed in service during the last quarter. Only this $2,000 was, and we can do the math in our head on this, that's not gonna be more than 40%, right? Oh, also, as an FYI, so this would be 7-year property, 7-year property, and 5-year property. So there would be a difference as far as which class life we're gonna use on those properties. Same thing, except that he purchased the truck on November 5th instead of May 4th. Now, if this was November 5th, now he's got 22,000 of that 29,400 of assets that was purchased in the last quarter. He's got to use the mid-quarter convention because he purchased that truck during that last quarter. If he had purchased this equipment in the last quarter, I don't think that's more than 40%. Think about it, 30,000 be about $12,000. No, okay, so that wouldn't be over 40%, right? Because it'd be around $12,000 would be about the 40% mark. So again, let me see if I can write that down. Kind of in a flow chart kind of way. So is it personal property or real property? If it's real property, you're just going to use the mid-month convention, which is the middle of the month that it was purchased. If it's personal property, ask yourself if you have to use the mid-quarter convention. Which is 40% or more of personal property in service in last quarter. Okay, so if it's yes, well, if it's no, that's easy. We're going to use the half-year convention. If the answer to this is yes, then total all personal property purchased, right? Total all personal property purchased in last quarter. And then divide, so 1, 2, 3, divide, what is it, 2 by 1, divide step 2, by step one. So if it's, I think here, greater than or equal to 40% equals mid-quarter. Right? Wait, well, I mean, that's when you would be determining it. So that's how you determine. If it's less than 40% equals the half year. So I guess I don't need this because this is your determination here, right? That's how you determine them. Does that make sense? All right. Questions?
For the recovery period, will there be any questions where we'll have to figure out if it's just regular equipment or peripheral equipment, because they're two different periods?
Well, equipment, if it's regular equipment or what
It
equipment?
says,
Oh, computer?
computers and peripheral equipment.
Yeah, no, they'll tell you what
Okay.
it is. Yeah, and that is kind of confusing because you think, okay, like the printer. Can you see it? The printer back there, like, is that computer equipment or is it other
So
equipment?
by peripheral, it means
Probably,
what's paired with the computer.
yeah,
Okay.
yeah, like it's attached to the computer, the printer, right? So that would be computer and peripheral
Okay.
equipment. But like a Xerox machine, that'd be different because it's not, I mean, a lot of times they are paired with computers these days, but you can use them independently without the computer as well. So. Questions? If you want to take a picture of it, feel free, if that helps. I know it's way down here, sorry. Maybe I should take, well, my camera's in use, so. All right, so that's our second, so that's the mid-quarter, mid-month, so you can see is, I want to start with the easy ones. Mid-month convention, and we're gonna use the same convention for the year of disposal. So we have to remember that. Oh, I was trying to say, so the computers will keep track of that, but if it's in the olden days, if it wasn't on a computer, you'd have a spreadsheet. You'd have to keep track of what your convention was. Because you wouldn't, if you've had this piece of, for 3 years or so, you're just depreciating it during the other years, fully depreciating it through all 12 months. So you might not remember if you didn't write it down. If you're like me, you wouldn't remember that you wrote it down 10 minutes ago. So we work with depreciation tables. I'll show you what they look like here in a minute. And all of the percentages, so what the tables do is they give you the percentage for which you depreciate during that year. You'll see in just a second what I'm talking about. So they've got like the year on the side, and then the asset class side, and then if you're like in the third year and it's a 7-year property, you can triangulate to see what the percentage you're going to depreciate during that year. And if it's the first year, it also bakes in that partial depreciation. So like it'll tell you, like if you're doing the mid-month convention and it's the third month, it will tell you what percentage to use for all assets that were purchased in that third quarter, not month, third quarter. It will bake that in. So the percentage is already there for you. However, in the last year, you have to do some extra math because the IRS they don't know, the tables don't know when you disposed of it, right? They can make the table so that you can choose when you purchased it, but they can't make the table so that so that it knows when you sold it. So you have to do an extra calculation, and that's what this is talking about. So IRS can build the first year depreciation percentages into the tables because they're known. IRS does not know in which year every taxpayer will dispose of property. So in the year of disposal, you have to divide the table percentage by 2 for the half-year convention and by the appropriate number of months for the mid-quarter and mid-month conventions. So you might want to bookmark that part because I think you do have some problems, so that you'll remember how that calculation works. So if it's a half-year convention and it says you depreciate it for, the depreciation percentage is 20%, but you disposed of it this year, then you divide it by 2, you depreciate it 10%. So whatever that percentage is, okay? And we'll do some problems here. Emin purchased a business computer system on November 3rd for $3,000. The computer was subject to the mid-quarter convention because in that year, more than 40% of the total asset purchases happened in the fourth quarter. That might not be the case in subsequent years, right? Other years, maybe you get to use the half-year convention. She sold the computer on March 5th, so she's still gonna use the mid-quarter convention, right? March 5th, the mid-quarter would be February 15th. In this case, Emin would take 1.5 months of depreciation on the computer during that year that she disposed of it. She disposed of it in March, but she's using the mid-quarter convention. So she's gonna stop depreciating it in the middle of the quarter in which she disposes of it, which is February 15th, which is a month and a half into the year. Or 1/5 over 12. 1.5 over 12 to get the proportion of the year that she gets to depreciate it. If she sold the computer in December, she would depreciate the computer for 10.5 months, or 1/2 of the final quarter plus the first 3 quarters. So then it would be 10.5 divided by 12. So if that percentage for the full year was, say, 10%, then we would take 10% times this proportion. Does that make sense? Okay. To figure out how much of that 10% you actually get. Does that make sense? Yes? You sure? Or are you just being polite? All right, well, like I said, we'll do some problems after we go through the methods. So, the methods, these aren't quite so bad. We only have those 3 choices. 200% declining balance, 150% declining balance, and straight line. And the tables do the math for you, okay? Except for if you have to do that, if it's the last year and you've got to do that extra calculation. 200% declining balance is, I guess I said that wrong. The 150% is the one. I think I pointed at 200% when I said this. The 150% is least used. 200% declining balance method is required for 3, 5, 7, or 10 years personal property. For 15 and 20-year property, so those farm buildings and those barges, 150% declining balance. In both of these cases, depreciation, remember I said it switches? It switches to straight line in the year in which straight line would yield a higher depreciation deduction. So the year that would be more than the declining balance, you switch over to straight line for the remainder of the depreciation. Okay? Straight line is required for all real property, depreciable real property. Real property is the easiest. It's mid-month, you don't have any choice between the conventions. It's either 27.5 or 39 years, and you only use straight line depreciation. So that the real property is pretty easy. It's personal property, it gets trickier. Salvage value is ignored, right? You can make an election to use straight line for any of the classes of property, but you have to use it for all of the property in that class then. that year. So you can skip using the declining balance. And everybody understands that if you're using declining balance, you're going to get a greater deduction in the early years. And then that deduction is going to diminish, right? All right. So here is an example from start to finish. Equipment, 7-year property. Purchase price, basis, $8,000. And a work truck. Work truck is 5-year property. Basis is $19,000. And an office building. Office building is 39-year property, $120,000. Now the good news is, once you have figured out which convention can be used, and this was all in May, so she doesn't have to use the the office building is just gonna be mid-month convention, right? So in the middle of May is when she's gonna start depreciating that. The 8,000 and the 19,000, those were both purchased in May, so we get to use the half-year convention. Nothing was purchased in the fourth quarter. All right. Once you know which quarter, which convention you're going to use, and which class life you're going to use, there is a table that you go to find the percentage that you're going to use to calculate that depreciation. And I'll show you here in just a second. So, equipment. See these percentages here? Those come from the table. Okay? Table. These are in the appendix. I think there's a quick jump to in Canvas, I believe, to, well, maybe or maybe not. This is the appendix of the chapter. Is this the chapter or I think it's the chapter, so there isn't a quick jump to in there. But anyway, so first table, half-year convention. Every piece of property where we're going to use the half-year convention, we're going to use this table. There's only one table for it. You'll see for some of the other tables, well, for the mid-quarter, there are different tables, there are 4 tables. But this one, there's only one table. So if you use the half-year convention, then what you do is you determine what the recovery year, or I'm sorry, what the asset class life is up here. And what year you are in recovery, right? How many years have you owned it? So if this is our first year, let's just say we'll say this is a piece of equipment. So it's 7-year property. And we purchased it for $10,000. We already know we're using the half-year convention. And we're in year 1. All right, so what we do, we look at our recovery year here, go to the 7-year, 14.29% is what we're going to depreciate this year. So we'll take the 10,000 times 0.1429. Our depreciation deduction is $14.29 in year 1. Now if we're in year 2, we're still going to take the 10,000, but we're going to multiply it by a different percentage. Now, in our second year, we get to take 24.49%. This is less because it's only half the year, right? So 24.49, 0.2449 equals 24.49. That's our depreciation expense for year 2. Just 2. So what percentage would we get for year 3? Yeah, 17.49%, so $1,749 would be our depreciation deduction. It's declining until it gets to year 5 when straight line would be greater, and then the table converts it for you. See, now it's 8.93, 8.92, 8.93. We're going to straight line now. This last year, now the half year convention, if you go all the way through, this last year, if you still own it, now it says year 8, which seems kind of weird because it's a 7-year asset, but remember that first year is only half a year. So it means the last year is only half a year. So it's actually into that. In order to make it a whole year, we got to go halfway into that last year. So this is half of what that straight line is. And then it would be fully depreciated at that point. If we sold it though, let's say we sold it in year 3. We still have to use the half year convention. 10,000 times, now we have to adjust this percentage. We can only take, this percentage is for the full year, and we only get half a year of depreciation. So we have to divide that by 2. So times 0.1749 times 6/12, 1/2, which is whatever. I don't know what that is. 17.5 divided by 2 is, I actually have a calculator. I can do. So this last year of depreciation, $8.745, 0.08745. So $874.50 for that last year. If we sold it, we got rid of it. If we didn't get rid of it, then we get to take the full year amount, the 17.49%. But we don't because we sold it. We got rid of it, so we only get half a year. That make sense? Okay. That's the half year convention. So again, you got to determine which table you're going to use. You've got to know which convention that you have to use. Okay? So half year convention, this is the table. You can see, like if we still owned this after 9 years, we don't depreciate it anymore. We have 0 basis in it. What's happening this whole time is our basis is being adjusted. So right here we started with a $10,000 basis. We're going to subtract the first year, $1,429. That means that our adjusted basis, so 1430 would be, let's see, 9, 8, 5, what do I have here? 7, 1. Our adjusted basis is $8,571. That happens every year. Basis adjusts downward for depreciation. It decreases with depreciation. It increases with improvements. This is our basis that we would use when we sell the asset. So if we turn around and sell it for $10,000, we now have a gain of $1,429. Coincidentally, the exact same amount of depreciation that we took, that we now have to pay tax on that gain. We got a deduction for it before, but now because we recovered more than recovered, or we recovered that original cost back, now we're gonna have to pay tax on that and a gain. We're gonna go into that more next chapter when we talk about gains and losses, okay, in chapter 7. But just kind of a little preview of how that works in, because we got the benefit up here Now we've gotta pay. If we sold it for $8,500, now our adjusted basis is higher than what we sold it for, we have a loss of $71. Okay? Which we can use to offset other income. All right, let's look at some of these other tables. Mid-quarter. I said mid-quarter has 4 tables. You'll see mid-quarter convention for property placed in service in the first quarter. They've got their own table. Each quarter has its own table. So if you've got multiple assets that you placed in service during the year and you have to use the mid-quarter convention, you're gonna have to use different tables for each of those assets. All right, same idea though. The asset class life is up at the top, recovery year over to the left, percentages right there. So if we have a property or let's see, again, it could be equipment. We'll just say it's equipment. And it was $10,000. Now we're using the mid-quarter convention. And we have to place it, we have to start depreciating, let's say the second quarter. I'll let you tell me what quarter. August 7th is when we purchased it. So what quarter? Third quarter, right. All right. So let's find the right table. It's not this one. This is for the first quarter. Second quarter. Third quarter. All right. This is our first year, year 1. $10,000. What percentage are we going to use? This is 7-year property, piece of equipment. 7.71. So our depreciation deduction is $1,071. Year 2. What's our percentage? So 25.51 depreciation. So you can see it takes into like this first year because it's for 7.5 months? Yeah, 7.5 months of the year rather than the full year. That's why we have a much lower depreciation rate. But it's a declining balance, so that means really that second year is going to be our highest, right? Let's see year 3 and we sell it. We have to know when we sell it. Let's sell it. Let's see. November 1st. We're gonna use the same table, but we've got to do the calculation. So, third year, our full year of depreciation would be 18.22%, right? 10,000 times 0.1822, and we could calculate that out, 1822 for the full year, but we've got to take a portion of that. We sold it in the fourth quarter. We get 10.5 months of it, right? So we're going to multiply that by 10.5 over 12 to get that proportion. So 1822 times 10 divided by 12. $1,994.25 is what I get. That make sense? I'm getting 10, because I sold it November 1st, but I stopped depreciating it November 15th. That means I get 10.5 months of depreciation that last year, from January 1st to November 15th. So I calculate out the full year's depreciation, but then I have to take the proportion of the year that I actually am entitled to. That make sense? That's probably one of the trickier parts of doing this, and the one that I get a lot of questions on from students, is that last year is complex. You have to remember that you're only gonna get part of a year in that last year.
Make sure my math is right, so basically, your only 4 options for the months is 1.5, 4.5, 7.5,
Yes.
10.5, those
Yes.
are gonna be your only numbers.
Yeah, for the mid-quarter convention,
Okay.
yes. All right, let's look at the straight line one. So there's the fourth quarter. So you've got to make sure you got the right table if you're using the mid-quarter convention. I mean, you got to make sure you got the right table for any of these, but keep in mind that the mid-quarter convention has 4 different tables, one for each of the quarters. Okay? Excuse me. I think those are. Okay. This, 27.5 years. Now you can see the percentages are all the same, because it's straight line. This is for real property. Real property is always straight line. Land we don't depreciate. Real property, 2 choices, 27.5 years for residential, 39 years for commercial. It's always straight line. So, except for the first year and the last year, which if you go all the way here, you'll see a percentage. Except for the first year and the last year, that percentage is going to be unchanged. In this case, we're using the mid-month convention. Okay? So that last year, our proportion is going to have to be, so like if it's July, it's as though it was sold July 15th, so that's 7.5 over 12, right? So let's look at let's say we apartment, and we paid, well, it's a small apartment, $100,000, and we bought it July 27th, year 1. Now you see up here, because it's all 27.5 year, we don't have different years like we did with the other table. It's 12 months up at the top. So, if we bought it July 27th and it was $100,000, what's our depreciation percentage the first year?
1.667.
Yeah, 1.667. So 1667 is our depreciation expense. What about year 2?
So 3.636?
3.636, which is what it's gonna be until either we depreciate it all the way until the very last year, whether we sell it or we keep it, right? So 3636 depreciation expense. Let's say in year 3, we sell it. And we sell it on, let's say April 14th. Right before tax day, because we owe a bunch of money, we need some cash. That's okay, I didn't know if it was our next, I don't know if our next door neighbors or not. All right, 100,000 times 3.636, 36, but we're not done because it's our last year. Times, remember we're gonna get 4.5 months of depreciation. We owned it mid-month, it was 415, we're pretty close there. Times 4.5 over 12. $1,363.50. For that last year. And our adjusted basis would be, we'd subtract that, and subtract that, and subtract that, and then we calculate what our gain is if we sold it. The 39-year property, now you'll see some of them, like there's a 7, so to round it out. They do have the 31.5-year one. I don't think you have any problems that use it. For the 39-year property, they condense to the second and through the 39th year here. Presumably because it doesn't, you don't need that, like it doesn't vary at all, like it does with these others. See, some of them vary a little bit to round it out. So this would just be, if our property was an office building, so our first year of depreciation, same convention, right, mid-month. So we bought it July, it would be $1,177 of depreciation instead of $1,667. Makes sense, it's being depreciated over a longer period of time. So that cost is being spread out a lot more than those shorter periods of time. Okay? My session is ended. What? Come on. Let's see. How far did this get me? See why I spent 2 weeks on this chapter? Methods. So there's an example. There, you can see, so in this example, they've got different types of property using different types of, different conventions, but those are the depreciation percentages. 5-year property, so it's a different percentage again. 39-year property. Excuse me. So kind of a little table here to show you what type of depreciation method you would be using. I don't even think about what type because the table tells you. The table does that for you, right? All right. I'm gonna end here because I've only got 5 minutes left and it's not enough time to explain the 179 expense deduction to you. We'll pick up here on Tuesday, though. So we went through all of these calculations. I would suggest that you, this weekend, start working on some of those depreciation problems in your homework because it's fresh in your mind right now. And if you wait, If you're like me, if you wait, it's gonna just, it's gonna fly away. So it really, and you know, one of the things that I listen to a podcast. I don't know if any of you listen to Huberman Lab podcast or heard of Huberman Lab podcast. Great podcast, science-based stuff. He did one on, and if I think about it, I'll post it, share it with you. They're long. They're like 2 to 3 hours long. So he did one on studying and retaining information. And one of the best things that you can do is to test yourself. Like to just test your knowledge immediately after you gain it. Like test your knowledge. So, you know, make yourselves some practice tests or something after your class, because it's one of the best ways apparently, according to science. Yeah, so 179 deduction, we'll talk about that. I gave you all these ways of depreciating, and I said that's how you have to do it. There are a couple other options. Like I said, it depends. And so we're gonna start going through those, but then we'll also talk about some of the other types of expenses. So this is one type of expense, business expense, depreciation. All right? Thank you for putting up with me having to end early.